What's going on, everybody? This is the blockchain backer bringing you the latest cryptocurrency news and analysis. Today, we'll be taking a look over here at the Bitcoin price chart, the altcoin market. We're actually going to take a look at a lot of macro things going on in the markets. As you could tell, my voice is significantly improved today. I'm excited about that. Let's jump right in. Bitcoin is still hovering in the range that it's been in for the last 6 days. The altcoin market, the same story. Same goes for XRP and Ethereum. So while we wait on price action to play out and give us a direction here in the cryptocurrency market, we're not going to spend too much time talking about the short-term action. We're actually going to take a zoomed out perspective, while at the same time trying to tie in the macro picture, which is changing. While I don't have all the answers on the macro, I do want to at least show all the things that have changed recently. As you know, throughout the year of 2022, as we're now approaching the end of 2022, the big narrative has been about Federal Reserve interest rate hikes along with inflation. For the majority of the year, the Dow Jones Industrial Average was moving to the downside until October, when it caught itself a nice big bounce. I've presented all of my arguments on why I believe that this is the ending 5-wave structure, while many were calling for the market to not be able to do any type of reversal or retracement until the Fed changed their narrative. The main ideology has been that we're doing some type of great financial crisis in here. And the thing that was published all year long all over Twitter and the internet was the Great Financial Crisis fractal. As we could see in the last month and a half, this has massively deviated away from the Great Financial Crisis fractal, which is what I assumed it would do. The reason being is that we are not in the same circumstances as we were during the Great Financial Crisis, where this is a broadening wedge that is range bound. We have now printed a giant bubble in the stock market. So at this exact moment in time, we have now gone back and hit retracement levels, including the 702 Fibonacci retracement right in there. Another thing that has happened has been a massive pullback happening here in the DXY. It's the biggest pullback we've seen since this rampage to the upside began in the earlier half of 2021. When you look at it on the monthly time frame, that is the biggest monthly candle in several years, even bigger than the green candles. You can even see on the relative strength index the loss of strength that happened in here just back in November as the parabola got broken. Another interesting thing is the massive turnaround in the 10-year Treasury bonds, with the current yield for the U.S. 10-year bond being 3.579%, and the federal funds rate sitting at 3.75 to 4% up here. For the first time, we are on the bottom side of where the Fed funds rate is at. And really, we see that in a lot of U.S. bonds. Even the 30-year bond had a bearish engulfing candle turnaround happen here, which we haven't seen happen this whole time. And you won't see it posted over there on Twitter because it doesn't fit the fear mongering. But 30-year mortgage rates have dropped by 1% in the last month, which is more tied to the 10-year U.S. bond. But still, something's going on with rates. One of the things people really look at in regards to inflation is gasoline futures. Oil and gas are the root of manufacturing and transportation. In the last 2 days, gasoline futures have broken below all of 2022. We are now back in 2021 pricing right now for gasoline futures. I'm certain everyone has noticed that gasoline prices have been coming down. As of yesterday and today, we are now back in 2021 pricing for gasoline futures. When we watched oil earlier this year as it was going parabolic and hit almost $130 per barrel, we had noticed that this was very similar to what happened to the 2008 run-up before things just completely fell apart. As we can see at this point right now, not only have we broken back below the Russia and Ukraine level from back in 2014, and where Russia invaded Ukraine again here in 2022, which sent it breaking out, not only have we broken back below it, we followed similar behavior to what we did back in 2008, bouncing at the same locations, heading back down to the lows. Will we break through and things really get tumbling? We'll see, but we can see that gasoline is already doing it. Also, one of the biggest fear narratives throughout the year with the invasion of Russia into Ukraine is what would happen with wheat. And we can actually see that wheat is breaking into new lows as well. Now down 41% off of the highs set earlier this year and back into early 2022, late 2021 pricing. Even over here on natural gas, we see something similar to talking about with like Bitcoin stop or Ethereum stop, right? What do you have? You have a big run up, you have an initial crash that happens here, one attempt to set a new high and then tumbles. And we get our first lower low in here with more weakness emerging in here, which is a typical setup of what's going to happen when we're going to go even lower, when we're seeing weakness emerging here in natural gas. So we're seeing commodity prices fall, and we're seeing shipping container prices fall. I remember back in 2021 when shipping prices were just exploding, and now they've just been absolutely tumbling. As we are now back to C19 and pre-C19 pricing for a shipping container, where from some ports, it got as high as $20,000. We're talking about the cost of moving a 40-foot container being $1,500 for years, getting all the way up to $20,000, now all the way back down again. So what does it all likely mean? It means demand is down, right? That makes sense. Whether or not people have lost their jobs or not, a lot of the free-flowing money is gone. All the stimulus and free unemployment money from back in 2020 and 2021 has dried up. The excesses that sent these things into parabolic bubbles are all gone. So is the inflation dragon slayed? If the inflation dragon is slayed, and if the justification for why we went down all year long in the stock market was due to inflation, well, does that mean we're going to head up now? Or does it spell bigger problems, that we're actually going to now start moving into deflation? Now, many will speculate that's not possible because the Federal Reserve will turn on the printers again. They will pump the markets. They will keep it going up for forever. But if you need a narrative to go through your mind of what actually happened, right? So let's say that the Fed even does start doing interest rate cuts, right? They do a 25 basis point rate cut because, well, they're about that above the 10-year Treasury bond right now. Is that going to send the market pumping in the way that it was, where they were just doing massive cuts? They were sitting at zero. Companies were getting free PPP loans that they weren't having to pay back, along with doing stock buybacks. Retail traders were getting stimulus checks dropped in their lap, even if they didn't lose their job. And those that did lose their job, many of them were making more money on unemployment, sitting at home, trading in the markets than they would at their regular 8-to-5 job. All that money, all that stimulus, 0% interest rates. Will we have enough strength on a 25 basis point rate cut to be able to exceed all the chaos that happened then? That's the big question. And to be clear, that's not what the market expects. The market does not expect a rate cut. You can see over here on Forbes, as the Federal Reserve's December meeting approaches, here's what to expect. The markets expect the U.S. Federal Reserve to raise rates by 0.5 percentage points at its next meeting on Wednesday, December 14th at 2 p.m. Eastern Time. That would be a step down from the large 0.75 percentage point increases at recent meetings. So currently, the federal funds rate is 3.75 to 4%, and the market expects the Fed to raise it up to 4.25 to 4.5%. The difference here as we head into that, and this could change before we get there, but for the first time, the 10-year Treasury bond yield is already below the federal funds rate. To the best of my recollection, on each rise, each time the Fed increased the interest rates by 75 basis points, they were playing catch up to the 10-year Treasury bond. Each time that rate increase happened, the 10-year Treasury bond was above where they were raising to. So the Fed wants to raise to here, but instead, the 10-year Treasury yield is down below the current federal funds rate. That is different from what we've seen during this entire hiking cycle, which means in the next 7 to 8 days, we need to see a big reversal here in the 10-year Treasury yield, getting back above where they want to take the federal funds rate to in order for it to be consistent with what has been happening. But currently, the 10-year Treasury yield sits about 25 basis points below what the current federal funds rate is. And to see that visualized a little bit better, you could see here on June 16th, when they did the first 75 basis point rate hike, it bumped it up to 1.5 to 1.75%. At that time, the 10-year Treasury yield was way up here at 3.3%. Then on the July 27th meeting, they did another 75 basis point rate hike, bumping it to 2.25% to 2.5%. At that time, on July 27th, the 10-year Treasury yield was at about 2.8%, so still playing catch up. Then, as they had the next interest rate hike over here on September 21st, the 10-year Treasury yield was sitting at about 3.55%, and the Fed funds rate got raised to 3% to 3.25%, catching up to the 10-year Treasury yield. Same thing happens over here in November, on November 2nd, as the 10-year Treasury yield sits at about 4.1%. They do a 75 basis point rate hike. It gets them in that 3.75 to 4%. Now, next week, we're supposed to have another 0.5% interest rate hike to get us up to 4.25 to 4.5%. What is the difference here is that the 10-year yield is not allowing it. So what's going to happen? So we're talking about all these things that are changing in the market. Big bounce comes in. The Dow Jones breaks away from the great financial crisis of what a lot of people thought was happening. Gasoline futures are breaking into new lows. DXY took a big knock to the downside. Container prices falling. The Fed still wanting to raise interest rates, yet the 10-year Treasury yield not doing what it's done for them for the whole way up. For the first time, the federal funds rate is higher than the actual 10-year yield. That has not happened in the whole hiking cycle. So you can kind of play it on your mind what would happen in here if there was a 50 basis point rate hike. What would the main narrative be? The main narrative would be like, hey, we're cooling down. We're stepping down off of those 75 basis point rate hikes. But what it would also say is that even though the 10-year Treasury yield is dropping and saying, hey, Fed, we can't go that high, the Fed still did it anyway, becoming restrictive and not caring about the 10-year. And so that would be a curious thing to see happen, because the narrative would certainly be, yay, we're done with 75. But at the same time, the 10-year said, we can't go any higher. And they did it anyway. So kind of some food for thought. We'll see how it goes. So we're in kind of this weird spot for the next week. We can see that the Dow Jones is taking a hard hit back here from the 702 Fibonacci retracement, but crypto has still remained ranged this whole time. Each person is entitled to their own thesis and their own idea of what's going to happen with Bitcoin and what's going to happen with the cryptocurrency market. But my thesis still remains that looking for a retracement, and there's two main elements to that for Bitcoin. One, the structure that it has had pulling down in here is absolutely nothing like what happened in 2014 and in 2018, which were both ABC corrections to pull back down. And two, I'm a believer, which is controversial, that Bitcoin is heavily tied to the Dow Jones Industrial Average. And so since I don't think that the Dow Jones Industrial Average is going to go on to a great, big, massive new bull run, I don't think Bitcoin is either. That's a very controversial thing to say. It still is highly unusual for an asset to just keep going down, 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 down with no relief. That's not what I'm saying for Bitcoin. You guys watched me stay true to what I thought about the Dow Jones Industrial Average being able to get a retracement back to the 702. It got it because that's what markets typically do. I do understand the cryptocurrency market has gone through its own series of events of just absolute contagion and disaster in crypto. When it comes to things like FTX, Celsius, Three Arrows Capital, BlockFi, you name it, we've had just a cluster here. But it doesn't mean I still don't think we'll get some type of retracement rally to come out of Bitcoin. I just don't think there's going to be enough juice for it to keep going on forever. But I do believe in this asset class. That's kind of where the big fight is out there right now. Is it Bitcoin and nothing else? Or is it blockchain technology and blockchain assets? I had the opportunity to see firsthand the excitement surrounding blockchain this past week while I was in Miami. Sure seems to me like it's more than Bitcoin. And will this be the end of the reign for Bitcoin? Michael Saylor sure wouldn't want you to believe that. But you have to realize he's got billions of dollars in one asset and one asset alone. His entire reputation is based on Bitcoin and Bitcoin only. He refuses to buy it down here, but he spent $1 billion in one shot up here. So I know there's a message trying to be pushed out there for Bitcoin, but I'm just coming at it from the chart perspective to say the element doesn't seem to be favorable for Bitcoin to go set a new all-time high. So while we see all these elements changing throughout the markets with inflation appearing to be cooling off, what's going to happen with Federal Reserve interest rate hikes with the 10-year Treasury yield not really being accommodative to the Fed to be able to do massive hikes? It's going to be interesting to see how things change because we're seeing the data change right now. So whatever narrative we've been believing or hearing or thinking we've been building our ideas off of, things are really changing right now. And I don't think a lot of people have recognized it. And that's usually how it happens. People didn't start screaming the Fed stuff until in here. This whole ride down from Bitcoin going from 68,000 all the way down to 36,000. No one was talking about the Fed that whole time. I mean, this is January of 2022. Nobody's talking the Fed here. Took a huge change in prices before people start becoming Fed experts. But we're seeing changes in data already starting to appear. And so I think our picture of what we see going on out there is going to change. And it might not be related to inflation, but might be more related to deflation. But I would just be so surprised to not see some type of euphoric rally of excitement and maybe the misperception of what's actually happening. And like an example of that would be how we can misconstrue the data that we were just talking about a second ago. If the Fed did a 50 basis point rate hike, what would most people think? Hey, sweet, we're not doing 75 anymore. But at the same time, what we see when you look at the real data is that the 10 years is saying, you can't do that. You're supposed to be going down now. But the general messaging out there is going to be, sweet, we're down from 75 to 50. So we'll watch the data as it comes. But I really wanted to kind of spend this time kind of talking more about like macro data because we haven't done that in quite a while. And what is the point of spending another day talking about that range when the big story is that Dow got back to that 702? And what's going to be the changing of the narratives that are coming now? And I realize this video doesn't really give the answers to everything because the truth is we haven't really lived through a moment like this before, where you had this big bubble get printed in the Dow Jones. You had interest rates sit at zero for years. You had this massive hiking cycle. Now the Fed suddenly doesn't have any room left on the 10-year Treasury yield. The DXY just reversed. The Dow just hit the 702 retracement. Bitcoin's been hit with all this contagion. It's a weird time, but we've spent a lot of time really focusing more on crypto. But I figured we needed a moment to at least peek over at what's going on in macro as well. Because it seems like something with the story of the Fed is going to develop next week. The whole thing with the Fed has been inflation. We've now knocked out all the 2022 gasoline prices, right? Container shipping costs have come all the way back down again. And now the 10-year yield is not giving the Fed room to do a hike. So I think we're going to see a story develop happen here in the next week. I'm kind of recognizing it in the data and in the charts, and we'll see how it goes as it comes. And otherwise, for crypto, for the altcoin market, still just holding the lows that we've been holding and in this boring range for the last couple of days. So we'll wait to see how things develop. We'll wait to get some more price action, and we'll take it from there. And that's going to be it for this one today, guys. This video took me a long time to put together. I actually ended up going to the gym. That's a little secret that you guys don't know about. If I make it all the way to lunchtime and I haven't finished my video, I go to the gym at lunchtime and come back with a fresh mind to try to pick it up again. But as you can tell, my voice is now getting exhausted all over again. So I'm going to wrap it up. We just poked around at macro today. It's been a little while. We'll kind of monitor those developments as they change. Otherwise, we're waiting for crypto to make a move, and we'll check in on it again tomorrow. But all right, guys, that's going to be it for this one. Thank you so much for watching. If you could, please like this video and give it a thumbs up. If you're new to the channel, please subscribe and hit the notification bell so you can be notified of when I create new content and when I go live. As always, this is not investment advice, and I am not a financial advisor. But if you ever need a pick-me-up or a little bit of reassurance, just remember that the blockchain backers got your back. Have a good one.